and basically saying anything that doesn't end up in bricks and mortar or concrete is bad debt, and that's your spending. So all they're saying that they didn't get much currency out of this, they were pushing the idea, but basically they're saying this is the infrastructure spending over the next few years to try and push up the amount of infrastructure spending to say it's good.
Are they suggesting that items like education or defence, because
bad
they
debt.
have a recurrent, are bad debt?
Yeah, because you don't see any money coming back, so not directly anyway to the government. So not a very clever way of putting it, but it's just that was their theme for the budget. But the overall, there is still a budget budget deficit coming down, but their assumptions are based on fairly heroic assumptions in the economy. Basically saying if the economy keeps growing, we can get more tax and therefore the deficit will fix itself. But they have pretty high expectations of the economy. They expect wages to grow from around 3.25% per annum, when we're only growing 1.9. Now, to go from here to here is a big jump because we've got fairly low wage growth. In Canberra, for instance, most public servants some haven't had pay rises for 3 years. I know in the AMP where we are, people haven't had pay rises for 5 years. How are you going to get that pay rise mentality back is going to be interesting because most people are finding it difficult to push up their wages. The other one is that they expect a big increase in income tax. Now, that's really driven off the fact that they hope wages go up, therefore that's where they collect most of their tax. Half the tax comes from wages, and that's where they're hoping to fill a bit of the hole. But my view is I don't think we'll see wages going up that much, and therefore it won't be filling their revenue hole as much as they expect. They also expect company taxes to go up. They expect the increases from company tax to go up by 55% in the next 5 years. But at the same time, they're reducing the company tax rate. So I don't know how they get to that equation, but they're basically saying that you can see here that that's the company tax take, but we know that they're reducing the company tax rates. So how they've come up with that is probably by saying that there's going to be more of a commodity boom recovery, which means that people like the resource sectors, which has a big impact on the economy. Resource sector will have improving commodity prices. That's probably the only way you can get that equation to work. But as I said, our corporate tax rates are way out of line with the rest of the world. I always see the average of the world's richest countries is sitting around less than 10% in tax. And we're still up here on the average percentage of total tax, still a hell of a lot more tax being taken out of the corporate area than many other countries. So the other one is that they expect growth to be very high. They expect around a 3% growth rate. You can see here, hasn't been doing that for the last few years, even after coming out of the GFC. We had a bit of a recovery after the first year after GFC, about 2008, 9, 10, but it's really not been tracking more than about 2.5%. So they're expecting now somehow to jump up to 3. So that's a bit heroic. So basically what they're saying is these things will happen and therefore the budget will contract, the deficit will contract and we'll be in surplus. But I think that's a pretty heroic assumption. But it is going the right way, but I just don't think it's going to go. I don't think 2021 is going to be the year that we're going to see a surplus. Unless we get a change of government where there's one party has control of the Senate. That's really where you can only get things through the Senate. And whichever government it is will be able to put their stamp on the budget. Even the Labor Party would probably bring the budget back into surplus quicker if they got in.
When does the Senate change?
Well, there's an election next year. The Senate changes, well, half the Senate changes every 3 years. They they had unless there's a double dissolution, which happened last time, they actually spilled all the Senate, but only half the Senate's going to be re-elected next year. So unlikely that I'll get a clear majority in the Senate again, because there's so many cross benches now. Yeah, Bob?
Oh, Russell, your phone number's not right.
I won't be too through. I won't look at that yet. No, it's only because you've got too hard a question. That's too hard a question.
That's a trick question.
Yeah.
So, the bank levy.
Bank levy, I didn't go to that much because it doesn't impact much on people.
But they're saying it's going to impact on superannuation.
Well,
I'll let you.
yeah, the way they're saying that could impact is because around 25% of the share market in Australia is banks, and okay, it's not all the banks are being affected, only top 5, but it'll potentially reduce their profits and therefore potentially reduce the projected profits. So when you're a shareholder, you're interested in two things. You're interested in the price going up of your shares, which is only really driven by the profitability of the share, or you're looking at the dividends coming in. So both of those things get affected by the cutback in, the increase in that tax. It's not a huge tax by international standards. In the UK, I think it's about 3 times what they're proposing here. But the banking lobbies come out pretty strong because they think, well, if they start at 6 basis points, they might raise it to 12 or 15 if they can get away with it. So if they think they can get away, the government can get away with an easy way of plugging the budget gap. The banks are trying to fight that now. They probably know that they won't win that argument, but probably try and stop any further rises in that tax. But ultimately, the banks will probably just increase all they have to do is increase their lending rates by 0.06%, 0.06, that's 6 basis points, so it's not a huge amount. And they've been raising their rates anyway over the last few years, out of line with the interest rates changes with the Reserve Bank. So I don't see ultimately, eventually the consumer's going to pay, not the shareholder, in my view. So hopefully that answers the question.
Well, sort of. The money's been that they'll go to the super funds, not just the consumer.
Well, the super funds are affected because if the profitability of the banks decline, my view is the banks will still find some way to make their profits go up, because all the banks are going to be faced, or the major banks are going to be faced with the same. It's a level playing field. So eventually they're going to all hide the increase with the next interest rate rise from the Reserve Bank, or they're going to do some out-of-cycle rate increases. So I don't think it'll be hard for them to collect it from the consumer, which is the borrowers. Ultimately, I don't see a profit decline, that's what I'm saying. Therefore, it won't impact on share prices, therefore it won't impact on super funds. Sorry, yeah.
Sorry, Russell. The AAA rating, there is concern about the continued imbalance in the budget, together with the increasing doubt seriously about whether that budget surplus will be returned at that time.
That's right.
There's concern that Australia's AAA rating will actually be adversely affected, which could in turn put up interest rates and change a lot of the implications arising from the current budget model.
Yeah, that's right. Yeah, agree. The big issue, as you know, is that governments are considered to be the safest investment for investors. But if the rates, if the credit rating goes down to say AA, it means you have to price in a hike on the cost of government debt, and then price everything else above that. So banks will have to pay more for what they borrow. It just spreads all the way through the community. So it's not just the government's costing more money, it's everyone who borrows money in Australia will have to pay more. So what we're saying here is, yes, it does have implications, but I'll put it in the context though that you've got countries like Japan with over 100% GDP debt and they still have a AAA credit rating. So I don't understand the logic of that myself, but it really comes back to that they seem to put Australia in a much, they put Australia under a lot more under the microscope because we've got a lot of housing debt and potentially government debts rising as well. So the rise in government debt in the last 5 years has been bigger, the rise in debt's been bigger than any other OECD country. So we've gone from, when John Howard left office, we had a $20 billion surplus sitting in cash, and Rudd very quickly got threw that out the window, and then run up deficits ever since, and then it's been trying to claw that back. But ultimately, yeah, the problem is that we have a lot of housing debt, and if we run up a lot of government debt on top of that, then the whole economy looks like it's too indebted, and that's where our issue is. But it's not, yeah, it's not good to keep running up deficits, as you say.
Russell, this proposal by the Chinese to spend trillions of dollars making the Silk Road a reality and all that sort of thing, that must be good for our mineral exports and
One
coking
road,
coal and that sort of
yeah,
thing, wouldn't
that's
it be?
right. Yeah, absolutely. I mean, China, before 1500, China and India were the biggest economies in the world. For centuries, not just a little while. They had the wealth because they had the technology. They had the gunpowder, they had writing, they had printing, they had a whole range of things that were over time after the Renaissance went to Europe. So European wealth has only been the last 400 or 500 years. So China now becoming the second biggest economy in the world, and potentially India later on, is going back to what it was before. So Europe only really went ahead because of technology. They took up more technology, where the Chinese economy didn't take up new technology, it became ossified. So the China's now retaking that, but as you say, the Silk Route, as you're going back hundreds of years, was where they were exporting silks and myrrh and all sorts of things which were wanted in Europe, from spices from India. So yes, it's a re-establishment of an old trade route, but now they're just going to put a dual highway from China through to London, basically. Well, not to London, but basically into Turkey, where it then goes into the European continent. So at the end of the day, yes, that means more trade. The Chinese are very concerned about the sea trade routes because that's why they've got that South Sea Islands. They're trying to put their presence into the South China Sea, is just to protect the trade routes. And if they've got an overland trade route, well, that gives them diversification. So it's also a defence issue as well. And they're building ports in Thailand as well, so that they can actually running a railway through Thailand up into China, and through Pakistan as well. So the big port in Pakistan, creating a big port in Pakistan and running a rail system through Himalayas. So it's a massive project, yeah, extraordinary project. But they save 25% of their wealth every year. That GDP is saving roughly 25%. They've got massive amounts of money they can spend on infrastructure and creating a new China that we don't save anywhere near that. But that's what they're doing. They don't want to cement themselves for the next century as the world player in trade. So, but as I said, it's just redeveloping what they already had 500 years ago. Well, sound good? Everyone's happy? No, we got a tax cut?
Just to follow up with
Yeah.
all that though, what is your assessment on the old perennial bricks and mortar versus, super funds and investment?
Well, I think that, yeah, my view is always a bit negative on housing, but because I don't see the revenue for people in housing. It's the revenue in realistic terms is too low. If you look at commercial properties, they're getting 8 to 10% revenue after cost. Houses are generally getting 3%. Now, it's because we've got an undersupply of housing that's keeping the market going. But eventually there'll be a time when housing supply equals demand or exceeds demand, and that's when you'll see the problems. And the problem comes over time is because The people who've got negative yielding properties are in the 45 to 60 year age bracket. As they come to retirement, they're finding they're not getting enough revenue to live off that property. They've made their capital gain, but they're not getting enough revenue off the property. So I find most people sell their rental properties when they retire. But if you've got, we've got the baby boomer bulge coming through, we haven't seen all those people come through the system to actually reassess their situation. They're fine when they're getting a tax deduction. They don't question it too much. They're seeing the house prices going up. But that's because we've got undersupply, and that means that undersupply creates the demand to push things up. And gearing has got easier over the last 15 to 20 years. You can borrow a lot more money than you used to. So that gearing effect is still very, very high. But now the government's contracting, putting brakes on interest-only loans for a start. They're putting more pressure on the banks to have more capital. So therefore the cost of borrowing's gone up for investors. The last 12 months they've gone up about 0.5 to 1% on investment loans, whereas you used to pay the same price as a home loan. There's a whole range of things that are making the housing market not as attractive as it was. So gains that we've seen of 8 to 10% when your wages are going up at 1 to 2, you just can't keep that going on because people can't afford to buy houses. So eventually you've got to have either a contraction in price or a very long period of flat pricing. That's my view. So I just don't like anything where you don't get a good income from. And not only do you not get much income, you can't raise rents very quickly because your wages are not going up much. That's the other issue. So if you do get a movement against housing, that you get an oversupply of housing and then people don't realise there's the capital gains there, you'll get investor sentiment coming out of that market. That's when you get momentum against that sector. That if it becomes a common concept that you would invest in housing, today you ask the average person on the street, say, would you buy a house to invest? And I say yes. Well, it's got to be a great investment. I see people who don't make money out of housing. But what I'm saying is the average concept in society is that you get your own house, you make some money on it, you see, well, why don't we just do an investment property as well? That's what people have done because they only really understand two things: their bank account and their house. They don't understand the super fund. They don't understand investing much. So often they're not translating that into other areas of investment. So yeah, that's my view. But yeah, other people, talk to a real estate agent, he'll tell you something different. All good. So I think we're all good today. So, but not too exciting budget. So overall, some little giveaways.